All right, let's go ahead and get started. So, let's just have well actually let's do this. Since we have the time, let's start at the beginning of the chapter. And let's talk about the systems principles. Okay, so when you set up a system, make sure you look out for controls. So, for example, one of the most effective things that you can do to prevent employee theft is set up a system such that if something is missing, you'll know immediately that it's missing. Now, you may not know who stole it, but if you know it's immediately, if the employees know that you'll know that it's missing, they'll be very reluctant to steal anything. Okay? Make sure it's relevant. Now, relevant, in an accounting sense, make sure that it gathers the data that enables the reader to make a decision. So make sure it gathers the data that enables the primary investor, but also the creditor, to make a financial decision. Make sure it's compatible. And so what this means is the fact that if you're going to computerize an ongoing system, get to know the system, and then set up the computerization such that it does on a computer what's currently being done in the system. So try not to violate an existing system, okay? Flexible. So for instance, the two most commonly used intermediate accounting packages are Peachtree and QuickBooks, right? Peachtree has a lot more capability. So if you start a business and you use Peachtree, you'll be able to stick with that accounting system for a lot longer than had you chosen QuickBooks. Now, in reality, if you're setting up a business, ask your CPA what system you should use, and your CPA will tell you QuickBooks just because it's so commonly used, that's what he or she will use. But, as an example of the consideration of flexibility, if you choose Peachtree, you can stick with that accounting system longer as you grow. And then, of course, there's always the cost benefit. So for instance, time flies, so maybe 20, 25 years ago, if somebody asked you to computerize their accounting system, probably the best thing you could do is just talk them out of it. Because in those, no seriously, because in those days what you'd have to do is you'd choose part of your system which you want computerized, find the software that would do that, and then find the hardware that would run the software. And then in those days the software always had bugs in it. So what you do is you keep the paper system while you implemented the computer system, because when the bugs would arise, you'd have a backup. And then finally, you'd have confidence in the computer system and you quit doing the computer. But the point of the matter is, in those days, the cost benefit just wasn't there. Now today, what you can do is you can get it off the shelf. And so, a couple $100, Peachtree, QuickBooks, the systems work, the bugs are worked out, they're easy to learn. Now, and so, it's now that it's changed with the good off the shelf, because now it would be an unusual business that wouldn't benefit from computerizing their accounting system. The only ones that probably would benefit, like suppose you do business over a wide area and there's a whole bunch of different taxes. Maybe you'd have to do that manually, but except with just some, with some real rare exception, almost everybody should just, computerize their system. And of course, what that also means is that information that was previously unattainable is now instantaneous. Okay, and it's really cool because in most of these systems, when you open it up, you have the opening screen, and that has all the things that you should need that day. It gives you all the information. And then you can get balance sheets. Not only in the format we've been having, but you can have them something like a pie chart that will show you the relative portions of everything. So, anyway, the cost benefit has changed. It used to be that the best thing you could do is talk somebody out of it. Now, it would be unusual for somebody not to buy it. I think we're getting into the components of the system, but you guys, I'm not sure, you guys are really up on that. Let's go ahead just a little bit here. And, okay. Much of what you're going to do is online. So for instance, not long ago, what you would do is you just back up your data to a CD or to a thumb drive and take it home. So that you then have the data at work and you'd have the data at home, right? And every night you just take home fresh data. And it would be, maybe you sit in your car, maybe even sitting in the garage. That way if there was something happened at work, a fire, whatever, you'd have all your data. Now, of course, you can back up online. Often what you want to do is you want to batch process. And so what this means is, instead of just doing it every day, set things aside till they accumulate and then do all of one thing at a time, okay? Often, of course, what you do if you have a small business, what you do is when the customer's there, Monday through Thursday, you do business. And let's say Friday afternoon in your line of work is slow, then do your bookkeeping on a Friday afternoon. You can just batch process it, okay? And of course, you can set it up such that it's in a network. Okay? Now, the ratio in this chapter is the segment return on assets. And that's the segment income divided by the segment assets. So for instance, the way QuickBooks does this is they'll identify what they, for instance, one of the things they have in there, to teach you how to use the system, they have this Rock Castle a business, right? And so this, actually it isn't Rock Castle, it's the other one. But anyway, what it is a store. Some of the stores sells bird stuff, right? Bird books, bird feed, etc. So what they do is all the assets that are utilized in selling that are identified with the attachment of the letter A standing for aviary. All the revenue that comes from bird books, etc., also has a letter A beside it. All the expenses that are included in that have a letter A beside them. So then what they do is they then can say, here's my net income that comes from bird stuff, aviary. Here are the assets that are involved in selling aviary stuff, and I can get the return on those assets. Now, the reason that's important is because different things in your business have different markups. Some are very profitable, some aren't. Sometimes you can even have a loss leader. That means that you lose money on it. But that's okay because it'll attract customers in your store, and while they're there, they'll buy the high markup items. Okay? But the overall business is profitable. But you need to do these things with your eyes open. You need to know where the profit's coming from and make the most of those. You need to know things that aren't necessarily profitable, but you got to have, because if you don't have them, people just will shop elsewhere. And then there's loss leaders that attract people in your store and then set it up so they're likely to buy more expensive, the high markup items while they're there. Okay? But that's how you can make those decisions. All right. How's everybody doing? Doing good? So then we moved into these special journals. Okay? And so how many special journals? First of all, why do you use a special journal? Okay, sure, it's labor saving, right? Because you're journalizing down to a fraction, down to half or so, and then because you're posting down to a real fraction. So special journals save labor. And they save labor. Now, what they do is, there's 4 special journals. What's one of them? Sales journal, okay? And what do you do? When do you use the sales journal?
Used for credit sales.
Credit sales, exactly. You have the cash receipts journal. When do you use the cash receipts journal?
All cash.
All cash in, exactly. You have the purchases journal. When do you use that?
Credit purchase.
Credit purchases, sure. And you have the cash disbursements journal. And that's for all cash out. So what this does now is these four journals, the sales journal, the cash receipts journal, the purchases journal, the cash disbursements journal, they'll save you a lot of labor. And how do they do that? Well, what they do is instead of having, and by the way, in addition to that, you'll almost always need a general journal. And you need the red general journal for accounts that don't fit in here. So for instance, if you have a credit sales returns, that won't fit in any of the special journals. Suppose you have a credit purchase returns. So this would be an accounts receivable, this would be accounts payable. That won't fit in anywhere. Now, purchase P-U-R-C-H-A-S-E, that wouldn't work. Now, if it's a sales return, but you give the customer cash, that'll go in the cash disbursements journal. If it's a purchase returns and your wholesaler gives you cash, that'll go in the cash receipts journal. But if it's a credit sale and a credit purchase return, then you gotta put it in the general journal. And then also don't forget things like closing, adjusting, have to go in the general journal. Okay. All right, now, how do these special journals save you time? Well, what they do is save you time and labor. Well, what they do is instead of having two entries as you do with the general journal, you post in columns. So let me put up an example of the sales journal, the one we worked with last class. And see 7-1B, here it is. All right, let's put this up here. So here's the sales journal and the cash receipts journal. So the way these journals save you labor is that it cuts the journalizing down to a fraction. I'm going to get past you here. Thanks. Let me make sure I knock that off. Thank you. Let me put this here. Okay. Could you hit the light while you're up there? Yeah. Okay, good. The last two buttons will do it. Yeah. Thanks. Okay. All right. So the way this works now is what you have here in Newsroom. So it's July 5th. Here's your accounts receivable customer invoice. This is checked when you post to her individual account, so you know if you're her, so this person's individual account. Okay, you have to update the individual account. The retail price goes here, and when that will be then debited to accounts receivable and credited to sales. Here's the cost of the merchandise, what you paid the wholesaler, and that'll be debited to cost of goods sold and credited to inventory. At the end of the month, in this case, at the end of the accounting period, you find the total and you post the total. And so instead of doing a whole bunch of individual postings, you post totals, and it just saves you a ton of work. Okay, literally a fraction of the work. Okay. Then you have the cash receipts journal, and then of course the reason these two these four have a column heading is because they're frequently used. Now, down here in the cash receipts journal, this is for all cash in. So with all cash in, you'll always have a debit to cash. So there'll always be an entry in this column. Okay? And July 15th, here's your Kim Newstrom. Explanation is the sale of 7.5. This check mark means that her account was updated. Okay. Now in this case, she owed you $18.40, and that will be taken off her accounts receivable. She qualified for the discount, and because it's the perpetual, and then that's a sales discount, right? Okay. And then the difference is the cash she gave you. Now, over here we have the other accounts. Now, if an account doesn't have its own column, it goes under other. And when it goes under other, it has to be posted separately, and here's where the posting reference goes. In this case, they borrowed money with a note, long-term notes payable is the account to be credited, note to bank. We posted it to account 251. Of course, it's a debit to cash of 20,000. This goes under other accounts. The total for the other accounts is found, is you calculate it because you want to include this credit with all the other credits to make sure that they equal the debits. Okay, so the sooner you catch an error and fix it, the least trouble you're going to have over it. So, right, so just check as you go along to see if you can find an error and fix it before you do anything further. Now, don't forget, what you need to do with this is you need to make sure that these journals work for your business. So this sales journal we have up here, you really couldn't use it in the state of Washington because in the state of Washington, we have a sales tax. So the sales journal needs to look different from that. So here's what the sales journal has to look like in the state of Washington. So in the state of Washington, here's my notes, what we have here then is the sales journal would look more like this. Instead of having the two columns, where the first column debits accounts receivable and credit sales, and the second column debits cost of goods sold and credit inventory, you'll have the date column. And again, this is the sales journal. All right. Then you'll have the account debited, and I'll abbreviate account ACC debited. The next column will be invoice number, and I'll put a pound sign for number. You'll have the posting reference. You'll have accounts receivable debit, and I'm going to put DR for debit. You'll have sales tax payable. You'll have sales, and of course that'll be a credit. And then you have cost of goods. Now I'm going to abbreviate cost of goods sold, COGS. That will be debited, it's an expense. And then you'll have inventory. That will be credited. Okay, and of course this, in the perpetual system, that second set of transactions converts the asset into an expense, right? So, now in this particular example, there's a $100 sale. There's a 3% sales tax. So 3% of that is $3. Okay, so what will happen here? In this case, let's say it happened on the date that the transaction is December 1st. Let's say it's for the Faber Company. The invoice was, in this case, the invoice is 7-1098. We're going to leave this blank until we post it to the Faber Company. Now, the sale was $100. The sales tax payable is $3. Add those two together, and our customer owes us $103. So the accounts receivable will be debited for $103. Sales tax payable will be credited for $3. And sales will be credited for $3. And then over here, we put $75. So we paid $75 for this merchandise that we sold for $100. Now, it's sales tax payable. It's a liability, right? It's not your money. You're acting as an agent for the state government. And it's a retail tax. You're collecting this tax from your customers. You're going to keep it and then send it to the Department of Revenue, right? And what happens in this thing is, how often you send it in depends on how big your business is. Often they'll, for something like this, what they'll do is have what's called a look-back period. And they say, like last year, what was your level of sales? And if you're a small business, where you have a small level of sales, they may ask you to send it in every quarter. If you're somebody like Safeway, who has a huge amount, they'll ask you to send it in every 3 days. And they try to determine an amount where you don't accumulate too much, and yet you don't send it in so often that it's a burden. Okay? And that's how the sales tax works. So the point of the matter is, when I did this, is that you have to set up these special journals so they match your situation. In this case, instead of having 2 columns for the sales journal, as we did in 7-1B, we have all these columns. The reason we have to is because now sales is a different number from accounts receivable because of the sales tax. So it can't have one column, it has to have two columns. All right, you guys doing good? Now, let's go ahead and do 7-3B. It will take the same data, except now we'll be working with the other two journals. So last time we worked with the sales journal and the cash receipts journal. Now we'll work with the purchases journal and the cash disbursements journal. So let me just I'll put this up here, okay? Let me turn the camera around so that if you guys want to watch this at home, it'll make sense to you. I'll turn out the light so it's readable. All right, so let me do this. So here's how this works. Well, actually, I'll just hand those out in a minute. So here's the way this works is, so what we're going to do now is, on this thing, here we have the purchases journal. And the purchases journal is for credit purchases. Now, here's how it's set up. Over here you have the date column, same as always. Here's the account to be the account. In this case, it's an accounts payable. It's Tahoe Company. The date of the invoice, the terms. It means that when you post it to the Tahoe Company, you'll check out that you've been posted. And in this case, you bought $6,300 worth of inventory, and of course that's $6,300 repairs. Now, by the way, guys, I'll hand out the working paper. If you want to, I'll hand out, just for your information, I'll hand out the working papers in a minute, ask you to get in teams, and we'll do 7-3B. Okay. But what I'm doing is just kind of familiarizing you with it. All right. Now, so don't forget, we have the accounts payable will always have an entry. Here we have inventory debit, office supplies debit, and we have an other column. Now, on the 7th, store supplies, and it's the prior company. Now, there are no store supplies up here, so it has to go under the other, and be posted separately, just as you did before. So much of this is a review, it's just a different format, because it's a different journal, okay? Just as before, now both of these were posted separately because they're in the other column, okay? You find the totals, just as you did before. You find the column total for the other, because you have to include it with the debits to make sure it equals the credit, okay? Let me just kind of have an overview of the cash disbursements journal. For now, this is for all cash out, right? And just as before, you have the date over here in the far column. Check number 300. The payee is the weekly, that's like a newspaper. You're going to debit an advertising expense. And it went to the other column, so it was posted separately. That's why there's a number in the posting reference. You credited cash for $575, and you credited advertising expense for $575. Okay. Down here, now don't forget you paid the Tahoe Company, right? When you did that, you qualified for a cash discount. Now don't forget, under the perpetual system, the cash discount is a credit to inventory. Do you remember why? It's because, don't forget, every asset is valued at cost. When you qualify, when you pay on time, qualify for the discount, you pay less for it. Therefore, its value decreases from an accounting standpoint because it's valued at cost. Less cost, less value. Okay? All right, and so this will show up as a decrease in accounts payable. This is the cash they pay you. This will show up as a decrease in inventory. Okay, here's payroll. Okay. All right. Now, are there any questions on this? You guys doing good? So let me do this. Let me hand out, I'll put this up here in a minute. Let me hand out the, let me hand out these. I think I'm going to turn this, excuse me just a second. I think I'm going to turn this off, or just because What will, now, if you guys